Hi, I'm John Mark Young, Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to the second installment of what we learned in the markets this week. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets, while also drowning out the agenda of the news media in America. To start out with today, I want to hit two kind of micro topics in regards to the markets. First of which is bear markets. You're hearing a lot about that on the news right now. The median bear market takes 21 months and produces a negative 30% drawdown. Non-recession bear markets tend to be shorter and shallower, declining only about 22% over 4.2 months. So far this year, we're down 20% over about 4.5 months. The Fed also is trying to cool the US labor markets. The weekly initial jobless claims data will become the most important high-frequency indicator of their progress on that front. In addition, U.S. stocks are snapping back from recent lows, just as they did in the second half of March. Now let's talk about the four things that we learned this week. First, in reference to stocks, large cap energy is still our favorite sector, even though it just made a new 52-week high this week. Here is why we think this group still has some room to work. Energy stocks are very cheap relative to the market. For example, Chevron trades at 11 times expected 2022 earnings for only about $15.52 per share. Now, if we look at companies in the market using the S&P 500, they're currently trading at 17.5 times earnings. So energy stocks are still much cheaper. Secondly, the Federal Reserve Chairman Jerome Powell said the central bank's resolve is combating the highest inflation we've seen in 40 years. And he shouldn't be questioned. Jerome Powell said, restoring price stability is a non-negotiable and it's something we have to do. The highest inflation rates are directly impacting America's biggest retailers, such as Walmart and Target. Speaking of those, point number 3, the next point, byproduct of high inflation rates, Walmart raised their earnings expectations in Q2 due to the pressures they feel from higher inventory levels and higher gas prices. This caused them to raise their sales outlook, but lower their profit expectations. The U.S. equity market rout caused by disappointing earnings over the last week hit major retailers like Walmart and Target, which supports the ongoing belief that by stock analysts that the market expectations for the S&P 500 earnings are still just a little bit too high. And lastly, point number 4, the previously owned homes report from April fell to the lowest pace since the pandemic started. According to the National Association of Retailers, Chief Economist Lawrence Yang, he says that he believes we're snapping back to pre-pandemic sales activity and expects even a further decline past that. So those are the 4 things we learned this week. Hopefully that was helpful to you. Certainly your advisors are watching this and trying to make decisions that are impactful to you relative to your personal situation, and we're always here to help and talk through any questions you might have relative to the markets. Thank you so much for your trust you place in Whitaker-Myers Wealth Managers. We look forward to talking to you soon.